kind of painstaking effort that Ajay takes, makes note, dwells deep into the topic that he probably looks at, into different facets and aspects that it can carry, and brings it on the table for us to understand in a very, very simple and holistic manner. So I think it's brilliant. Let me have the pleasure of introducing Mr. Ajay Bagga as well. So let me welcome Ajay Bagga. Hi, Ajay. Good afternoon.
Hi, good afternoon. Thank you, Mayuresh.
Thank you so much for taking time out. It's really a pleasure and a gratitude because I've known you personally as a person, and conversations with you, Ajay, even for half an hour that we used to have, was so enriching and fulfilling that I think it really made my day whenever I used to meet you. So thank you so much for taking time.
Thank you. I'm
Great.
delighted to be here.
So great. I think a lot of users have already joined us. So the first question, Ajay, I think let us directly jump into the aspects that the economic situation and how the entire market situation is at this point of time. So you've been seeing and you've witnessed markets over the last 3 decades. This asset cycle and the market cycle that we are in at this point of time, how different are we from the previous market cycles if we are? And if we are in a unique proposition at this point of time, what are those aspects that you need to bring forth so that our users and listeners can understand your perspective on how we stand at this juncture?
Yeah, I think that's the trillion-dollar question, because now millions and billions don't matter. And I would like to pose one question, which everyone should think about, and that will make a lot of money for you if you can crack it. I have been, one day I woke up about a week back, and early morning I just sit, like today the moon was setting on the western horizon and sun takes about an hour later, the sun was rising. Tomorrow being full moon, it's a very beautiful sight over the sea in Bombay. So that early morning when there's stillness, and I woke up and this question struck me because I was reading a lot, Mayuresh, on the Spanish flu pandemic. There hardly anybody alive who saw that 1918 to 1921 pandemic. So it's a once in 100 years kind of a scenario that we went through. So living history, nobody knew what to do. The big question that, as I woke up, the first question that really struck me was, are we going to see the roaring 20s as happened in the 1920s? And it culminated in 1929 in a very big melt up and then a meltdown, which then lasted for nearly 6 years. So are we going to see the roaring 20s, or are we in .com 2, where, and within .com 2, are we in 97, are we in 98, are we in 99, or are we in 2000, or are we in March 2000, that Julian Robertson is going to return all his money on mid-March, and next day the market crashes. That marked the peak of so the old fox returned his money. He says, I can't make money in this kind of a market. And next day the market crashed, and then for 12 years the market went nowhere. So if we can get some insights on this question, are we going to see the roaring 20s? So we have a runway of 5 to 9 years ahead of us of great global growth, or are we somewhere in the .com 2 where a crash is coming? Maybe we have 2 years in that kind of a scenario. I think if we can get some insights on that, that will be the crux for our performance in this decade. The second big poser, and there is no right answer for this. We will only know in 2030 that whether we raise. I know this is the right question. I don't have the right answer. Nobody does.
Absolutely.
So we have to do the best we can in a probabilistic sense. And in 2030, if we are alive, Mayuresh, you and I should again revisit this and play this video and talk about it again. But I think this question is right. Roaring 20s or .com 2. Second major poser for us is that in the financial markets, you can't eat your cake and have it too, or you can't have your cake and eat it too. So have we had a lot of our cake for the future 3-4 years in terms of the valuations, and do we have to pay the price now in terms of starving for some time till the earnings catch up. Because markets are very strange. Markets, when the economy was falling, the markets rallied up. So when we had the worst ever GDP performance, April to June last year, the markets were galloping away. And now when we know that 20% plus Nifty gains this year are very much there in terms of earnings growth. In fact, it'll be 25 to 30% probably.
Sure.
We are just coming off last quarter where Nifty 50 has given 22% earnings growth. Top line was more or less flat, but 22% earnings growth we have seen. 35 out of the 50 Nifty stocks saw an earnings upgrade of more than 5%, Mayuresh.
Yes.
That is the kind of stuff we are coming from. But all of us are skeptical that, this is, the market is frothy, market is in a bubble, market will crash anytime. So be with this question. And the third big thing is we have to identify where are we on the business cycle, where are we historically. For example, I just wrote an article last month on commodity super cycles. And this is you've seen that. So this is the seventh big commodity super cycle starting in the last 227 to 30 years. And commodity super cycles last for a decade or more. Materials have underperformed over the last 10-12 years. Energy has underperformed. Industrials have underperformed. The last melt up we had in industrials was when all mutual funds were launching infrastructure funds in 2007-8, and those prices never came back. So commodity super cycle, real assets outperforming, financial assets having had their day last year. The big mantra, I will come back to it towards the end. I would like to reinforce this. Write it on your desk and keep it. There might not be returns in the market this year. There will probably be returns within the market. What does that mean? January, the way we ran up, and half of February, we met this year's targets for most sell-side brokerages. 15,800, 16,000. Wo ho gaya. That is done, dusted, packed away. Now what happens when markets outperform like this? They turn into consolidators. And within the market, a big rotation starts. That rotation was due on a decadal basis. So if you see the first decade of 2000s, the last decade of 1990s, then 2010 to 2020, market was setting up for a rotation. And this year we might have seen the highs, and we'll probably revisit the highs and then go back, revisit the highs, then go back. Because when you have a lifetime highs in the markets with a lot of economic growth, but a provision of maybe interest rates rising within a year's time, then the markets tend to take a little back seat. The real economy takes the front seat. And all the stimulus that has been pumped in over last year, that has given a $45 trillion return in the global stock markets last year. You put in $23 trillion in monetary and fiscal stimulus. The market cap gains were a huge, unprecedented $45 trillion last year. So the financial markets have enriched everybody. If you miss the boat, too bad. Will you get that 100% return again this year? No way. That is the only thing we are certain about. Rest, I think markets will be going up, correcting a bit, going up, correcting a bit, coming back 10%, then running up again. And within the markets, if you can figure out the sectors and the stocks, that will be the big performance. Last year was macro top-down work. Anything you bought did very well. Some went up 8-9 times, some went up hardly one time, some did not go up. But overall in the market, you made 100%. So from March 23rd to March 23rd, if you made less than 100% on your portfolio, you were either in a mutual fund or you don't know what you're doing. So And if you have made 40-50%, don't congratulate yourself too much. It was the market which gave us the gains. We did. इस साल जो पैसा बनाएगा, who will make money this year will really, be the great fund manager. And I think mutual fund guys will come into their own this year. Alpha generation is possible. Index might not perform. Actively managed funds, active PMSs, and active stock pickers will outperform.
Brilliant insights, Ajay. Thank you for your remarks on this one. So I think, yes, I think more or less, I think as Ajay is saying, this year might be a year of consolidation more in terms of sector and stock picking would be the key. So we will get there in the latter part of our program on what sectors and how sectorally Ajay is probably looking at the markets. But Ajay, since you track the macros so damn bloody well, when you track the foreign flows so well as well, I think the questions that are now coming forth, right? And that was a very funny tweet that I received. You might have received that as well, that everybody used to track the Dow. They've got one more tool like the bond yields to probably track and play around with every evening, right? So the yield movement has been sharp. The Fed statements are still indicating that growth is going to come back gradually, and they're not too concerned with the inflationary trajectory, and they still it's a way away. But if you map all these aspects together, and if you want to put it in very, very simple terms, how do you probably look at all the debt raising exercise that global economies have done worldwide? The debt to GDP has gone over the roof. What are the concerns, if any, right, structurally from a market perspective, even though bankers are saying that liquidity will not be withdrawn? Do you see any outside risks to that? And with the yield movement, does that affect foreign flows? Because you've probably seen a lot go towards the dollar. And a fourth question, if I would bundle all of that together as well, what happens to gold in this entire context as well?
Yes. Oh, very, very good questions. I might forget them, so please remind. I would like your views also on all this, but just to take them one by one. Where are we on the cycle?
Yeah.
You have to differentiate between rebound and recovery. India was going down. We were set for a recovery early last year. All the December 2019 reports that we got were talking about India finally seeing a recovery after 5-6 years of setting the foundation, and then we got the COVID. So now what we have seen, Mayuresh, we have seen the rebound so far. We have not got into the recovery channel yet. And I think that will take another 2 quarters probably. Recovery in some countries will take maybe 2 years also, especially Europe and Japan could take longer. So recovery is uneven. Rebound has been quite fast because 2008 lessons were learned. So, in 2008, nobody knew what to do because the last time we had something like this was 1929. And Ben Bernanke had done his PhD thesis on 1929. So he knew at least what should not be done. But the politicians didn't understand. So if you see from Lehman going down in September to Obama releasing the first tranche of funds, it was February. And moment that fund announcement happened, that was the bottom of the market. Market starts turning in March, and then it just takes off. So you went down 60% on the back of the market. And then once Obama came in and the TARP and all these, about $800 million came into the market, it just took off the market, and then it never looked back. This playbook, Bayuresh, was learnt very well by global central banks. So there was no misstep. Unlike 1929, unlike 1934, unlike 1973, even 2000, there was no misstep. The Greenspan put was learnt very well, and the central bankers knew what they have to do in March. Even our, Shaktikant Das ji was really a superman. The way he cut the prices, the way he put so much liquidity into the markets. And Fed stood there. They didn't even just say that we will do whatever it takes. They gave a backstop to the corporate bond market, which did not melt. In fact, junk bonds raised huge amounts of money. They just carried a big stick and showed the world that, if you misbehave, I have this weapon available and I will use it. That was enough to hold the things together. And then nearly about 40 interventions happened in the course of 40 days.
Yeah.
Unlike last time where it took 273 days and then the market turned. Now, all of us missed it, quite frankly. Uh, who were the wisest investors? The retail Indian, who stayed invested through cycles. All the HNIs, family offices, all the smart money, all missed it because they were looking at the historic playbooks, Mayuresh,
Yes.
where bear market normally lasts 24 months. So they said, "Itna sharp in 19 days the market's fallen so fast. It will take maybe 6 months to a year minimum before it gets out of bear market territory," not realizing we would be making lifetime highs again. So it was one of a kind event, but historically it was a continuation of 2008. Lessons were learned very well. And because the stimulus came early on, both fiscal and monetary, $23 trillion were put into a global economy, which is worth about 80 trillion. So you had a 25 or 30% kind of a stimulus coming into the global economy upfront. No questions asked.
Yes.
Backstops provided. So bears were just skinned alive and sent to hibernate. Whoever tried to short that market.
Yes.
Now, why portfolios didn't do so well? Because there was a very big contraction in terms of which sectors did well and broad sectors which did not do that well. So if you were in the fangs, your portfolios took off. You were the ARC kind of funds or the Wolf kind of funds, which were all the work from home beneficiaries. You did very well. You were in the liquidity based sectors, which is normally a late bull kind of a phenomena. It's not an early bull phenomena.
Agree.
So if you had unprofitable technology stocks in your portfolio, you did very well. If you had SPACs, special purpose companies, which have nothing as such on their balance sheet, they just raise money on hope, you did very well. $1 trillion of IPOs happened with unprofitable technology related companies. Or if you changed your name to Zoom or technology or anything like that, you did very well. All the rest of us were just wondering, markets go up, but my portfolio doesn't go up. So if you had the Hritik stocks, you did well. The two HDFC twins, if you had in your portfolio Infi, TCS, Kotak, these kind of stocks, if you had, you did very well. But rest, if you had a diversified portfolio, you were not doing as good as the market. So those were some of the lessons. 2008 lessons were learned. What was missing in 2008, Mayuresh, is the Abhimanyu effect. So we know the entry to this. Japan entered in 1990 and they are still not figured out in 30 years. How do you exit this? Exactly. So to answer your second question, what happens to the governments? Governments are very leveraged. The way money has been printed, there is no fundamental or economic or gold backstop to that money. So you have done a huge liquidity around the world. Classical economics, if you print more money, so more money chasing lesser goods leads to hyperinflation, as happened in Germany in the 1920s. If you read a bit about that, it's very scary, where, billions of Reichsmarks were equal to $1. So in wheelbarrows, you will carry this much notes full of a wheelbarrow or a sack to buy bread. And employees were being paid daily wages because the currency would lose its value if you paid monthly. So that's what happens when you print too much notes. It's not happened with Japan. Actually, they've had deflation, degrowth. So governments and central banks have to figure out. 2013, Ben Bernanke tried. After 5 years, he says, I will taper the QT. And the QE, So, moment he said that in May 2013, global markets crashed so badly that he said, okay, I'm not tapering, we stay committed. This time, Powell knows all that. And him not being a classical economist is helping us. He's ready to experiment. He's saying, we'll hold it. And third, then, where are the yields going?
Yeah.
The bond markets, Mayuresh, ran ahead of themselves. And only now we are figuring out what happened. Because we kept asking, the swap rate was showing that the Fed funds rate will increase only in May 2023. Even when in February, the bond rates went from 90 basis point to 160, 170, it came to March 2023. So for 3 years, even the Fed swap yield curve was showing there is no interest rate hike. The Fed itself was saying 4 years, no hike. So what was happening in the markets? Now we are getting some clue. One is the big funds, all the global funds had to rebalance. They were rebalancing every month anyways, but if you are making 100% from last March and you were supposed to be 60% equity and 40% in bonds, your equity portion had all of a sudden gone to 80% or 70% or 65%. So nearly $170 billion plus came for rebalancing over this last 1 month. Nearly $7.5 trillion of funds had to rebalance. So some were like 68-32, some were 62-38, some were 60-40. There was a lot of bonds that had to be bought. There were a lot of equities that had to be sold. The equities reacted. The bonds saw this as a reaction that inflation is coming. And guess what? For once, I used to always say bond market is the James Bond. It sees much more clearer. Equity market is its sidekick. And we though have no clue. We just pretend we put a story after the event, that this is what happened. But bond market got fooled. One is the amount of quant money, because today what is happening, fund managers like us are getting sacked and computers are running a lot of the money globally. And they are being programmed by the same software guys. You and I sitting there with experience would have told this time is a bit different. Don't take it on those criteria, because $23 trillion has never been poured into the global economy. So the 10 criteria on which quant bond funds were acting and saying inflation aa gaya sab bhago was totally wrong. Your swap curve was showing what is right. The Fed was shouting from the rooftops, don't worry, kuch nahi hone wala, but the bond market panicked. So it was quants. Second was this rebalance trade.
Sure.
And now if you see, as the rebalance trade is finishing off, you're seeing bonds are recovering. And guess what? Yesterday, US inflation came at 1.3% annualized. The core inflation, despite oil hike, despite everything else, despite agri commodities going up, global commodities going up, the PCE deflator came at 1.3%.
Wow.
So what were we talking that end of this year, inflation might be 2.4, 2.5? I don't know. So with this kind of liquidity, I don't know is the best defense for all of us, but we have to make money. So we have to give answers. But frankly, if the central bankers didn't know, if the best money managers didn't know, what is our chance of knowing? So I'll give you a strategy to play this also.
Wow. Okay.
But I'm just saying that with so much liquidity, it becomes very difficult. What happened to gold? Gold gave a great performance last year, up 24%. Its second cousin, silver, gave 44%. And after a long time, we were seeing, after 2012-13, that the gold cycle was turning. And the thesis was dollar becomes cheaper, dollar will depreciate. and gold will get a benefit. Second, commodity super cycle is on, gold should do well. Third, as the inflation increases, gold is got a good correlation, and gold should do well as a store of, you know, as a protection against
H.
inflation, because it will give a little more than inflation kind of return. So as inflationary expectations increase, gold will do well. What worked against? And this, in our previous seminar, somebody had asked, and I didn't catch it. And I went and studied it later. I should have caught it better, because I bought a lot of gold last year and didn't do too well. Made the 20%, but I stayed invested. I should have got out. One very big thing that changed in August was that central banks stopped buying gold. The Russians and Chinese were buying a lot of gold. The second big thing was Indian consumer and Chinese consumer didn't buy gold last year as
Yeah.
it was running up, because discretionary savings were being kept in the pocket and in the bank accounts. uh, Gold was not being bought. So then the World Gold Council numbers unfortunately came too late for us to figure out that August was the top of the gold in the intermediate. My own understanding was February gold turns, but then all this rebalancing and all have pushed it forward. But super cycle hai, commodity super cycle is there.
Absolutely.
The good news is Chinese lunar year, Mayuresh, the sales went up a lot, gold. We also got hit because the custom duty was reduced. See,
Yes.
traditionally, the gold smuggling is a big source of finance all across the value chain. So nobody removes the custom duty. It pays a lot of money to various powers that be. Now, the government took a very tough view and reduced the customs duty. So the gold holding MTM went down overnight.
Yes.
So that was another thing that India had to face. And then the dollar was one-way trades. Everybody was short dollar. Stephen Roach had come out of wherever he was and said, "Okay, dollar will be down 30%." I should have woken up then. And but there was one way. It was all one-way positions. Second, the uneven recovery, where it's a galloping U.S. Economy this year. First quarter, despite the Texas freeze, despite Northeast freeze, first quarter US will grow 7.3%. Goldman is talking about 8% growth
Yes.
for US this year. That, emerging markets, India will be happy if we do 8%. Imagine an economy of the size of US growing 8%, while
Yes.
Europe will be negative to flat.
Yeah.
So that divergence has led to a safety first flight into the dollar, which is again unexplainable if you go by the fiscal deficit or the
Yes.
increase in debt or the kind of note printing. You would have thought dollar would start weakening. But what we forgot was that there is unstated, undeclared currency war also on. Japan wants to reach 125 yen to safeguard its exporting currencies. We saw that in 2008. Over 2004 to 8, I have seen yen at from 75 yen to the dollar going all the way to 125. And imagine if you were on the wrong side of that trade. I
Right.
had customers who were just wiped out.
Absolutely.
So, and people were borrowing in yen and stuff like that
Absolutely.
because it was low and they had nothing to do with yen. But yen positions were there, and corporates got very badly mauled in that. And if you added Swiss franc into it, the bankers made a lot of money. Corporates lost a lot of money. 2007-8 lesson. So Japan wants a weak yen. Europe wants a very weak euro
Euro.
to keep. And China decides who it's going to hurt the most. And at times it will slash its own wrist, like the oil producers when they stop producing oil to keep the prices up. China will see what are the speculative positions. If too many shorters are there on the yuan, they will lead them on. and then one day they will take action and wipe out all the shorters. So dollar going up became a point of worry. Overall, very strong correlation with emerging market flows, reverse correlation. So if dollar goes up, you see capital outflows from emerging markets.
Absolutely.
So last year, our thesis was when we were getting 40,000 crores, 60,000 crores in October, November, we said dollar will weaken further. We will not get 40,000, but we should get the 20,000 crores should come to us. Yeah. Despite a strengthening dollar, we got this month 4,500 crores.
Yes.
That's good. And despite rebalancing. So, story in short, gold will go up, but maybe this year we won't get much further appreciation. We'll have to wait a year more. But overall, given the note printing, gold should go up. But for us as investors, Indians already hold too much gold. So we need not get more into gold. 5 to 10% of portfolio is what we recommend. I think all of us have more than that already. Yes. So I think we can give it a slip. You can go into the copper, you can go into aluminium, iron ore, steel. All the materials will do very well. Oil is a different story. Oil, because still there is excess supply over demand. The other thing is 3 countries you have to watch closely. Easier is Libya. Libya was divided into 2 warring factions, Turkey, Russia, US, France, all playing their hands there. Yeah. Now there is a unity government. And what happens then? Libya has started pumping 1.5 million barrels a day, which has come in. So the Saudi cuts are taken care of by the Libyans. I'm sure one of them, either Saudi or Turkey, will intervene to break this government and ensure this supply doesn't come. But for now, the supply is coming. Second is Iranian oil. Now, Iran officially is not exporting any oil, but the Chinese are very actively taking Iranian oil to beat. Nearly 1 million barrels a day the Chinese are taking. So what is happening is the ships are carrying the Iranian oil, and on midway they shut off their transponders. The ships are tracked using the transponders, and the oil is then put into Chinese vessels. Once they reach a Chinese port, you can't say this is Iranian oil or North American oil or Middle East oil.
Correct.
So nearly 1 million barrels a day China is now buying of Iran, and they are settling it in their currency, so the US banking system cannot sanction. China is also buying from Venezuela, nearly about 500 million barrels a day. 17 million barrels they bought in February itself. Venezuela, they are taking oil in return for hard dollars and in return for all the food stuff and all the other commodities that Venezuelan regime. So again, it's a sanctioned regime, but China is buying. That is the real story of oil. And we were expecting that Biden would move fast to bring the Iranians onto the negotiating table. Correct. But this 1 million barrel which is being sold by Iran, it is giving them the space to stand off with Biden. If there is a return of Iran to the negotiating table, then Mayuresh, 3 million barrels a day come in officially.
Absolutely.
That will break oil. That's why when oil was touching 70, I was saying everywhere that this is toppish. Yes. There are too many other sources which will start coming in on oil at that level. And that's what happened. It went down to 60. Now, because of the Suez Canal issue, it's gone to 64. But that's temporary. Maybe it might take a week, 10 days, whatever. Cost is a lot. If you have to bring Middle East oil to Europe through Africa, the cost goes up. It's like nearly 9,000 kilometers extra they have to travel. And it's another, as it adds nearly $300,000 per day to the cost.
Yeah.
So that's what the oil market is reflecting right now.
Brilliant. Ajay sir, this was brilliant. In fact, I did not have to repeat my questions. In fact, you added on the crude part, which I was about to ask. The kind of statistics, analysis, and numbers you're putting forth, I think you cannot put that any quant model. So I think it's all programmed to your and wired to your brain, which comes
That is what I agree with you. And in fact, you make a lot of money if you can anticipate what will the quant do.
absolutely,
See,
absolutely.
they kill us on the scalping. So small they do. But if you just sit like the old fox and wait for them, then you can make a lot of money.
Absolutely. So I think points taken on all aspects. I think the carry trade, as you said, I think if it doesn't work in your favor, I think it can be disastrous to the positions that you're carrying. Charlie Munger and Warren Buffett, you would have read the letter as well, sir, in their annual letter that they give to Hathaway shareholders. Their comments on the yields were very, very prominent and noteworthy to note. And all the insights that you put forth, and I hope all the users also understood that pretty well, because you put it very, very simply. Yeah, I think their view was also simple. I think bond yields, they said, is impossible. I think all the factors around it, I think, does not make it for a scenario as well. Crude, absolutely agreed. I think the kind of insights that you gave on crude, I think even I was not aware of that. In fact, all the users, I would recommend what Ajay sir has written on the commodity cycle. I think go through that. I think it's a brilliant piece and insights with years and years of experience that he has put into that. And last but not the least, when you're probably talking about the entire dollar flow movement as well, I think those insights were brilliant as well. Which brings me back to the point, Ajay sir, is if you're probably talking about all these aspects from a macro perspective, and then you're probably saying and assuming, right, that liquidity will still hold true at least for the next 3 to 4 quarters. Maybe earnings come back. Maybe there is a mismatch in terms of forward valuations as far as the overall index is concerned. But some sectors where earnings growth might be there might continue to grow at a faster pace compared to the others. So in this positioning, I think a two-part question. Do you really expect, or do you foresee and probably predict that the markets might crack? Because the perception here is that in a bull market, short corrections come through for all macro reasons, and markets find reasons to correct. All these reasons come together at this point of time. So do you see a major crack coming, or do you see that it's going to be a consolidation phase, as you said in your opening remarks? Some sectors doing well, identify those sectors. And two, if you are saying that some sectors will do well, what is your thesis in terms of which sectors will do well? Are they commodity driven in your opinion, or is it more product and platform based that you see?
Very, very good question. And, I was reading a research from Arizona University. They put out very excellent research, Mayuresh. And they used to track the US markets. It's like 100-year research, 1926 to now. And they even did the Indian market this time, 3,500 companies in Indian markets. And just to boil it down, it takes a lot to read all that, and calculus I never liked even in school, and I still hate. I'm the old world economist. I love to just read the theories, but not to have the empirical backing to it. I trust my gut more. But what that is showing, Mayuresh, that 4% of the companies contribute more than 100% of the market returns.
Yeah.
This is on 66,000 companies across some 20 markets.
Wow. Okay.
It's not that it's one and decade by decade they've done. And I was very fortunate to have worked with companies which were in the top 3 at that time. When I worked in Citibank in the 90s, it was in the top 3 market cap. GE was at the top of its game when I worked for it in the 2000s. So having seen from inside, you also realize that. Now, the big thing for us as retail investors, if you ask me today, for the next 20 years, which will be these 4% companies, I can't say. So for us, then the biggest way out is diversification. Yes, you do choose, you have a bottom-up stock picking approach, but also knowing that we don't know exactly which company will be that long-term winner. But even if you get 3 out of those 10, a big chunk a big chunk were not even giving 1 month treasury returns, Mayuresh. Nearly
Wow.
65% of those companies, you were better off in just having a bank fixed deposit.
Correct.
So
True, true.
another
Absolutely.
mantra is markets are designed to inflict the maximum pain on the maximum numbers. Now, since everybody is going passive, everybody is saying fund managers don't matter, let me buy the markets, ETFs are being created. I don't know how it will come. It's an unknown,
Agree.
it's an unknown known. Something will come which will upend the index movement. That it's become too easy. People are launching zero cost indices, and something will come. And
Absolutely.
a lot of thought I put into it. I said, what will come is index will not perform, but your stock picking will perform. And that's how
Absolutely.
the active fund managers and the PMS guys will come back into their own. The good guys will really outperform. I think that will come. And the quants are getting so huge, they're getting so market moving that you will have very sharp moves both ways. Volatility will increase. You put in liquidity plus you put in quants ruling the markets. And with what SEBI has been doing, it's taking out one source of liquidity, the retail investor in the F&O.
Correct.
Those volumes are drying up. So markets will move very sharp. So for you, first, you have to survive. Second, by being diversified, you increase your chances because we are not Warren Buffett's. We don't know these 10 stocks to buy. There are probably 100 guys in the world who know that. I don't think any of us here know that. So diversify. Third, you increase your chance of success by holding for long periods because something or the other will click at that time. You have, I'm not saying buy blindly, but out
Yeah.
of the NSE 500 mid caps, can you identify 20 of the top stocks on all the parameters? Management, return on capital employed, return on equity, uh, free cash flow growth, EBITDA and all is, it's good, but
Yeah.
I would go for cash flow, actual cash flow, what is coming, the scenario in that sector, and the competitive positioning. Just 4, 5 very simple things. You boil down to 20, 25 of those NSE 500. Five of them will be 100 baggers over a period
Absolutely.
of time. And that takes care of your financial freedom. Can't make it
Brilliant.
simpler. It's not easy. If you ask me, give me your 25 picks. I can't be held to it.
No, no,
So
no. Absolutely, point taken, Ajay sir. So, I mean, the thesis that I wanted to put forth is that a lot of product stroke tech related companies, platform based companies have done
yes,
phenomenally well, right?
wonderful.
And the expectation largely is that over the next decade, it belongs to them because digitalization, the expectation in terms of more indigenous way of looking at things will probably come forth. What I was trying to put forth is a few sectors that you feel that over the next few years or decades, or in fact over the next 4 to 5 years, I think some sectors, I think we're not even looking at stocks. I mean, are you looking at product tech companies? Are you looking at the commodity players? And if you are expected to park your money within equities in the overall asset allocation that you've got, which are these 3, 4 sectors that you are probably looking at over the next 2 to 3 years?
Yeah. No, this year you have to have a barbell approach. And what is that? You have to be in growth and value both. Value is coming back after 20 years odd. Value will see you know, uh, its position in the sun again. Right now, you have to be on cyclicals. So, given the commodity cycle, given the economy recovering, what does well? At this part of the business cycle, mid caps and small caps tend to outperform because when the economy expands, the small guys also get a chance in. And if they have not been crushed over last 1 year of COVID, then they have emerged stronger.
Yeah.
So the winners in the small cap, mid cap, in a percentage sense, will gain much more. But you have to stay with growth and quality also. So I would say IT pharma has had its year last year,
Okay.
has underperformed last 3 months. But the winners within IT and pharma, if you can get them, Those will be your growth part. Uh, there's a lot of this digital play which will come into the IPO territory very soon over the next 3 to 4 months. You should start seeing some of those gaming plays and digital plays, e-commerce plays, payment plays, the disruption of the banks itself that is happening on the fintech. So three big techs which I've really won over the last year: health tech, edutech, because children were all at home, so whoever could fix this for the parents. Edutech has won, health tech, of course, and fintech. Fintech stays the largest funded market. Unfortunately, the private equity guys have a lot of money and they are not leaving much to come to us, because those companies are not listing, they are
Yes.
unprofitable also. But the private equity guys are just juggling the ball between themselves. Hopefully, some of them will flow through, and the Zomatos and all these will see the light of the day. Uh, that would be a good entry point. Again, valuations are not cheap, but the growth is high. See, again, when people say that if you had held Amazon over the last 20 years, this is the millions of dollars every $1,000 of yours would have made. It takes a lot of courage to do that. It's not easy.
Yes.
Amazon lost big chunks for so many years. So it would go up and then it would be down 40% for a year. Most of us would have had stops triggered. So for someone to have held, you have to be very lucky.
Absolutely.
Otherwise, on a normal steady state. So the money that you put into digital India or digital world, keep that aside, carve it out as your gambling money and say, I am looking for the next Amazon. Don't put large chunks.
Okay.
So, suppose you have, let's take a number, 1 crore to invest. I would say take 10, 15 lakhs aside, and each of these digital themes put in a lakh and then leave
Okay.
it.
Okay.
Just leave it. I won't be around, so you won't be able to catch me. You'll have to come to
No,
heaven.
you'll absolutely be around, Ajay sir. You're not
But
going anywhere.
25, 30 years, uh, one of these will be a thousand bagger. One of these will be your Amazon.
Point
It would
taken.
have taken care of you. It happened to me. I give this example. You're well aware of this. We were working for Citibank. Citibank had an in-house technology company called Citil. We got stock options. I had to borrow money from my father. That cost of that stock is 72 paisa for me. It gives a 160 rupees dividend every year,
Wow.
and the stock price has gone to 4,000 also. It's about 3,000 to 3,200. It goes down to 2,500. I don't bother. A classical wealth manager would tell you it's very foolish. The stock has not given returns for 10 years. I'm very happy with the dividend.
Absolutely.
I'm not
Absolutely.
asking you to do that. I get 25 lakhs of dividend a year. It takes care of my annual expenditure. I don't need to do anything else. I put in 8,000 rupees into this stock. And I didn't
Wow.
have 8,000 because my Citibank salary was 5,000 rupees per month after doing a top notch MBA from a top premier institute. But my father gave me the money. He had the foresight. He says, take it. 8,000 rupees I put in. And today it gives me 25 lakhs dividend. I said,
Wow.
that is possible. If you ask me, identify one, I didn't know at that time. I really didn't know. And there might have been 20 other companies which I thought, especially our generation, we saw the worst of Harshad. We saw the CRB scam. We saw the leasing and finance company scam. I mean, do you know ITC and Wipro and Tata used to have finance subsidiaries which are not existing now? We have
I've heard
lost
about
money everywhere.
Yes.
But because of that, you have got so polished. Being part of every time someone came to take money off the retail investor, you were contributing to their pockets. That after 2-3 decades, you have one or two winners. My ITC holding, for example, is at about 11 rupees
Wow.
because of the bonuses and stuff. My HDFC Bank holding is virtually at sub the IPO price because of the splits and the bonuses.
Wow.
ICICI Bank holdings, IPO came at 35 rupees. I mean, with the split and the bonus and all, you get more in dividend than what you put into them.
Absolutely.
That is what happens when you compound with great companies. And for digital, we don't know which will work out, which will run into the ground, especially at these valuations. The good thing is put small amounts in a lot of them. The best investors will say concentrate everything into one or two. But then, you're dependent on one Zomato or one Swiggy, and you don't know whether Amazon is launching Amazon food or some big daddy comes in with deep pockets and disrupts. So I would rather have 15 Zomatos running for me, and one of them will come good.
Absolutely, point taken, Ajay sir. And thank you so much again for this. But again, specifically on your commodity supercycle note that you've written, because of paucity of time, can you just quickly take the users who have not read that? Obviously, I think I will request everyone to go through the note that you put forth. But a quick takeaway from all the analysis that you've done. Which commodities, in your opinion, stand out within the entire supercycle that you're probably seeing over the next few years?
See, for India, very clearly, we'll have a lot of infrastructure expenditure. US, the biggest guys, are talking of a $3 trillion infrastructure bill over the next 6 months because their infra is really creaking. Last 1 year, none of us have gone, but you go to the US, there are roads, bridges, everything. So metals are in a super cycle. China has to grow. The world has to redo its infrastructure, and full Africa, India have to build infrastructure still. So metals, you are seeing already 1 year it's done very well, but you stretch them out 5 years, 10 years, they have really underperformed the indices.
Sure.
So a lot of thing on ferrous, non-ferrous metals both. Oil, because India is regulated, not too much there. Maybe with the PSU privatization might throw up some things, but otherwise oil not much of a play within India as such. Gold and silver, I think this year might be soft, but it will catch up because the consumer demand is coming. I had expected February the dollar wash to happen and turn trade to start. It's not happened. I think it's got postponed by 3 to 6 months, but it will come. It will come down the line, maybe next year now. Then who are the suppliers into this infrastructure build-up? All your industrial companies. So go for companies without very high debt levels, good managements who have been steady through 2008 and this down cycle. So you will get the good idea. There'll be a lot doing very well also. But, if you don't like those practices, sooner or later they will skid. So stay away from those, or where there's a whisper that they are front companies and all. Stay away from those. But stick with the quality in industrials. That will do well. Cement seems to be in a good cycle. We saw very good numbers last quarter, where they have been able to squeeze costs and maintain pricing. March pricing has gone up again. And there is a huge runway for the cement companies. Very boring companies, well-researched companies, but you'll get steady eddies here. The runway is huge. So
absolutely.
For the steady part of the portfolio, industrials, materials, the home improvement, cement, durables, these all, the revenge consumption will come, Mayuresh. Both corporates and individuals have huge savings accumulated. Corporates will spend it into building factories. Individuals will spend it in consumption, in experiences. Everyone, the cruise ships 1 year down the line are getting fully booked. Everybody is saying if the world is vaccinated by end of this year, next year, so, cruise mein jayenge.
Absolutely. Point taken. So again, I think, Ajay, some 2-3 odd questions that I will just take forward before we take a few questions from the users as well. They've already started putting in questions as well. So on the aspect in terms of cryptocurrencies, right? That was a big theme: digital currencies, crypto, blockchain as a technology. What is your view and stand on that?
I wish I, I wish I had invested. That's the first. But all my learning, which doesn't count for much, you just think what is backing it up. So if you hate gold as having no cash flow, how can you go for crypto? Uh,
Exactly.
but it's got a momentum of its own. So if anything is in a bubble, Goldman brought out a bubble report about 2 weeks back, and they had really charted, and crypto is right there. Ray Dalio also took
Correct.
out a bubble
Absolutely.
report, and where he gave percentiles for most sectors. And crypto, he just said, "Haath jod ke the sooner or later the regulators will ban it globally." So, but now it's got a momentum of its own. The Morgans and the Merrills are launching
The
funds.
lower currencies. Exactly.
So, but all the central banks want to launch their own digital currencies, which will have some backing. It won't. China is already doing experiments, and if you see the latest BIS Innovation Summit, where all the central bankers spoke, if you go to that site, excellent insights on fintech in every country. And the main theme was this digital currency. So everybody's talking. But look at it, Norway, which is a cashless economy, there virtually no cash left in Norway. Everything is digital. They don't allow cryptos. So somewhere the regulators are afraid of the money laundering, the terror
Yeah.
financing angle, and the bubble angle. See, bubbles form when too much money keeps on bidding up and till the buyers are coming. It's like the tulip mania. What was tulip mania in Holland? That youths were stuck at home because of the plague. They said,
Yes.
"Chalo, satta lagate hain flowers pe. How much tulips will come?" And churches and nuns were selling tulips in the forward market. अभी वो
Absolutely.
उगना है tulip and वो बेच दिया और when it crashed, someone tried to sell, there was no buyer
No buyer.
and it wiped out. Or South Sea bubble, where Newton lost most of his wealth. First, he went in, he made a lot of money, he got out. Then he got greedy, he entered at a higher level and put all his wealth, and that finished. So South Sea was that you are, uh,
Yes.
so is Bitcoin that? I don't know. I'm not qualified. I don't believe in it. So I'm in that old school who thinks that it won't work. But the sharpest mind, Elon Musk, thinks that it works. So he must be more right than me. Take your own call. Government of India is banning it shortly, and you will
Yes.
get about 6 months to declare and move out. So, and if you see the latest accounting requirement also, they are asking companies to declare if you have invested in any
Good.
cryptocurrencies around the world. So I foresee that as a regulatory crackdown. But
Sure.
if you have offshore money, which is in your under your LRS and all, and if you're allowed to hold it, by all means, small amounts can be put, but there is no basis to it. So
Oh,
normally it
absolutely.
ends badly, but we are in the raging bull bubble of Bitcoin. So right now, whatever I say doesn't make sense.
No, absolutely, I think, and you're absolutely right in this sense. I read a lot of articles itself, and the thesis that you put forth, Ajay sir, I think that absolutely counts for it. In fact, Charlie Munger, in one of his interviews recently, had also mentioned that he has no clue in terms of the functionality and all the aspects you put forth, and therefore to put value to something which does not generate cash flows and has no asset backing behind it logically. How am I supposed to bet on something which has theory, I mean practicalities like that, where I'm an old fox, as you said, right? And where I believe in cash flows and strong payouts as well. Now coming back to the commodity part of the business, EVs has become a very, very prevalent part, and everybody is talking EV, right, at this point of time. So getting out of your combustion, your traditional combustion engines, and getting into EVs over the next 5 to 10 years. Obviously, auto angs will probably get into certain parts and molded elements of EVs a different angle. But for commodities, I think, how are you looking at certain commodities attached with EVs? So I think nickel as an example, lithium as an example. So are you viewing those, Ajay sir, in a scenario where you see a bullish trend happening?
Yeah, definitely. That goes without saying. And but again, how to play it in India? So you
Yes.
saw moment Tata Chemicals said that we'll get into batteries. It just got re-rated, or global car companies. Just your name is whispered with Apple making the EVs, and or yesterday we had Xiaomi saying that they would start making electric vehicles. So
Vehicles.
this is back to the early 1900s when there were more than 500 auto companies when the auto was invented, and then it came down to 4 5 finally. So now what will happen is everybody will climb on the bandwagon, but
Absolutely.
that value addition is not there. You look at Tesla itself, 100 times PE, and people are giving $3,000 numbers to it, or very reputed JP Morgans and Goldman and Morgans are taking out 2030 reports saying that it will sell X million cars at Y margins in 2030 or 35. So that is bubble territory. That
Absolutely.
happens, and biggest thing we saw was in 2000, or Harshad in 92 when he would give the his own theories on Mazdas and all these,
Yes.
where there was nothing, or how to set up a plant and what will a plant cost today. So it's something like that is happening on the EV side. So a lot of froth. The good thing is the big auto majors are getting into it.
Yeah.
I would rather, bet on a Volvo or a Mercedes or Daimler getting into EV. They'll do a much better job. What has been told to investors is that there's no automobile manufacturer. They are all software guys now.
Yeah.
And but the reality is you need a car which should work, which should get serviced, which should you should find the spare part, which should give you dependability. It's not software. It's an
Absolutely.
actual transportation you're using, and safety first. All those things are there. So Tesla is a great product, but I don't know the valuations, Mayuresh. So I think the traditional guys are not sitting by. I talk to a lot of the petroleum industry guys, because see, for them it's a existential crisis
Absolutely.
if the EVs come in, and very interesting insights you get from them. So those guys are saying 10 years it's not earth
Possible.
shaking. uh,
Okay.
it will not move for the needle 10 years in the automobile segment. Then it will start off. So they see the petrol and the diesel engines hanging around for next 10, 15 years at the least. And these are the guys who have to really research it, because their business will be finished if this
Oh,
goes.
absolutely.
So
Absolutely.
I played, because the car guys will give you a very rosy picture. The victim will give you a better picture. So my friends in ONGC, Oil India, Shell, Schlumberger, these are the people I go and ask them, and they give a very good reality check.
Yeah, absolutely. And that's why your insights are so very, very profoundly followed, Ajay. One last question before we take questions. The entire divestment privatization theme has picked off, right? Ever since the budget announcements were done. Your personal view, Ajay, in terms of both divestments, do you think that government getting off, example again, BPCL, if they put forth an example thereof, or how earnest is that effort, and will foreign flow seriously come through if you are able to successfully experiment and show that we've given you one example like this and follow much more? So what is your views on divestment or privatization as a
See, we do best when we have our backs to the wall. So 91, we actually did. I was working in a foreign bank, and that foreign bank had cut India's lines. That was the reality. We had 2 weeks of foreign exchange reserves, and our gold was actually flown to Bank of England. So we pawned our gold, and IMF arm twisted us. But what Dr. Singh did then, I mean, that defined India. What China did in 79, we did in 91. So we
true?
do very well when we have our backs to the wall. 2008 also we did well. Why we ready ensured that we missed most of the trouble in the banks. The bank troubles came later on, but he had started taking, and then Dr. Subbarao coming in did more. But right now, Are we in that crisis mode? Do we have our backs to the wall? Is there political capital backing? Dr. Singh had Narasimha Rao backing him. I am skeptical, in short.
Okay.
So, because the opposition, because of the political compulsions, and there is a very huge framework of bureaucracy which eats rents from these public sectors. It's not going to be that simple. We have seen with Air India, we have seen with all these. Within, it's like Numaligarh, you sell to an Engineers India and stuff, or you sell HPCL to ONGC. That stealth might happen, but big ones will be difficult, especially banks. Uh, is very visible. The unions are very strong.
Yeah.
I think banks will happen because you get a package and it's not a thing. But for example, Hindustan Zinc, we have no reason to hold on to. We can give it to Vedant and make our money and balance our budget to some extent. They're already running it. So that's an easy portion. It's not getting done. So these are pointers, but all when you are looking at these, these stories come every 2-3 years. Before every budget, railway stocks will go up, PSU stocks will run up, and then they go down after that. See the extent of the crisis. Fiscal crisis is there, but the whole world is printing notes. So we are not that badly off. The fiscal deficit going to 10% this time was just you brought onto the books what you were already borrowing in NHAI, FCI, and stuff like that. Which, as analysts, when we were we would do the country's balance sheet, we used to add back. We were never fooled that your fiscal deficit is 3%, 4%.
Absolutely.
You would take states and you would take quasi-sovereign, which would be your NHAI, FCIs and all. So you just brought it up, but actually it's not increased. So will the bureaucracy allow it? Is there political capital? I think you had a chance in 2019. Now sitting in 2021 with the farmers on your back and less than 3 years, this is the year to do it. If you get it, after that 2022, there will be no appetite left. So yes, LIC IPO will come. That will be a big one. Those kind of tactical moves will happen. But a broad brush, I don't think so.
Absolutely. Absolutely. Thank you so much, Ajay sir. So we'll head out to questions now. 3-4 questions because we've got paucity of time, and I think we've already spent an hour 15 minutes with you. So one of the questions that has come on my private chat is a lot of IPOs have hit the market. So I think, do you think that there is a bubble in the making or a market top because so many IPOs coming in? Is this an indication of a market top in your opinion?
IPO market probably topped, and that always happens, So start of the cycle, the promoters and the merchant bankers leave enough for you on the table, and then they start getting greedy, and then the side deal ones start coming who say that okay, we'll rig up the price to this much and then leave the retailers with the cans. I think that third stage we have reached. So IPO market bubble, yes.
Sure. One more question is that a user is asking that consumption is the only bright spot in the India story at this point of time, specifically post-COVID. Barring that, I think most of the factors seem to be a little bit on a very soft side. So your view on this, and in regard to this, where do you see the Indian market over the next 2 years?
See, what we must understand is we are more like Japan and the US, whereby consumption makes a big chunk of our GDP. Sure. Unlike China, where investments and industry and manufacturing contributes, for us, it's consumption. And that's our strength also, because our wealth is quite widely distributed. And with the government's redistribution policies, 13 lakh crores, they say they have distributed over the last 6-7 years, and farmers getting, so safety nets have been made. Yeah. And by monetizing the FCI foodstuffs, it was a master stroke by the government, sure. Where food was lying there, and that was given. So nobody was really starving in the COVID. Everybody had the grains reaching them, and we have the infrastructure in place, both financial as well as the public distribution infrastructure. So in that sense, we did very well. Now, going ahead, we have to watch out, is what I would say.
Absolutely, Ajay. One more question which has come forth is that you spoke a lot about fintech, edutech, and health tech stocks. Again, I think for users, again, I think Ajay will not mention stocks. Very, very clear. I think, but is there any way to play this? Is there an ETF or an index, or is there some alternate way to play this, or any clues that you can give to the investors on how could we view these spaces?
Yeah, so see, first, you must own the banks in India and start with the private sector banks. They will also have fintechs embedded in them and they will buy the fintech. Second, as companies come on IPOs, see, the PE guys don't allow us to participate. They are keeping a lot of it and that value addition. So, अगर 100 का value add होना है, the 90 तक PE ले जाता है.
लेके जाता है.
Because they take the risk. And they find, I was shocked on seeing the ownership of the promoter in some of these companies has gone down to 10%. Yes. It's all the tigers and all who are owning it. And they will harvest huge
Absolutely.
return.
Absolutely.
One of my friend wrote to me the other day, and one of his investments, he runs a fund, and one of his investments made 22 times returns in 3 years. And He said, because of this one investment, my entire fund is up 1.35. So, you can do 99 गलतियां भी कर लो, एक वो जो आ गया 35% return दे गया. That is the magic of PE. They take the risk also, but they're not leaving enough for us. So keep watching out. In terms of listed, of course, there are a few companies which have listed players in that. And then IT we have to stay invested. So the top 4-5 IT companies, because they will be suppliers. They are getting into cloud. They are doing digitalization. They will all keep on supplying to these companies.
Absolutely. So I think it goes with our O'Neill methodology as well. Finding leaders and sticking with leaders in spaces.
आपसे ही सीखते हैं, 88-year-old William O'Neill is the starting point of any fundamental investor.
So thank you so much, Ajay sir. You all convinced me a lot. One follow-up for your banks, the bank element that you put forth, Ajay sir, with the moratorium period getting over, right? And when true NPAs will now start coming through, specific from a reporting perspective, is that a risk that banks and NBFCs are carrying on their balance sheets?
Not much. Most of it is declared in pro forma NPAs, maybe 1% more slippage, because restructurings have not happened. Banks have not been sleeping. They didn't declare it, but they were meeting all the problem accounts, and not much restructuring has been reported. So maybe a 1% slippage, not more than that. 10,000 crores for this compound interest waiver. That will come as a hit, but there are more or less mostly baked in by bankers, and largely they won't have accrued this, or at least they won't have applied it. To use bank speak, accrue is when you accrue it, recognize it. Apply is when you actually go and debit the customer account. I don't think application has happened at all. And as far as accrual goes, a lot of the bigger banks are not even accrued compound interest. So that 10,000 crore hit might not come. And that's what the market is showing last 3-4 days. The Supreme Court judgment came, market went up, then it fell immediately.
Yes.
Same night it had gone up again. And last 2 days, as the rebalancing exhausted out, we are seeing the banks coming back. Banks we have to own this year. Banks, industrials, materials, these cyclicals, and banks, again, if you put it on a 10-15 year performance, public sector banks, 12-14 years no performance.
Absolutely.
But I'm saying when you have private sector banks, might be overvalued, but they are the better quality. Public sector, maybe the top 2-3 might be worth some, but you have more than enough on. And same with NBFC, stick with the top 4-5. Don't go down the chain. MFI, the risk is every government wants to waive every MFI loan. And वो क्या होता है, one villager comes to know, the whole village stops paying. So it becomes an issue. But politicians are taking the easy way out. In Assam, it's there. In Tamil Nadu, it's there. Bengal didn't mention MFI loan waivers. But, so that's the continuous risk that MFIs are running. So that's why I like the higher level banks than going down the. There is a fortune at the bottom of the pyramid. But I don't know if that is the fortune in the politician's pocket or in the customer's pocket. Bank के pocket में नहीं है. It's like telecom, not good for investors, good for the consumer.
Consumers. Absolutely agreed. Absolutely agreed. And therefore, I think what Ajay sir is trying to put forth is where earnings remain strong and where earnings is expected to remain strong, even if valuations are a little bit on the higher side, it does make sense to stick around with that. One last question before we call it a day, Ajay sir, I think is a question on the renewable sector. So how do you foresee this in terms of what the government has put forth from 6% to 15% over the next decade or so how do you see the renewable sector, solar, wind, and if any, I think what's the best way to play this if you indeed are bullish on the renewables as a theme?
No, renewables are the way to go, but again, in the listed space in India, it's all very managed and very high valuations. It does not. But the good thing is, multinationals are coming and buying. So, top end companies are buying stakes at this level. So, put some into the listed space, and rest we have to wait and watch. But this sector will do very well. Uh, since we can't play it directly, you can look at the transmission companies, you can look at the grid providers, because usko link to karna padega na. You are
Absolutely.
making solar in a rooftop, but who will carry that power? So,
Absolutely.
or the suppliers of the gensets, or supplier of the equipment, we can look at those. Not too much in this space directly listed, and their questions are there. So small amount we can put, but it is a mega trend. It will do very well globally. So if you have global portfolios, there are a lot of options are there. Within India, options are still limited. It will come. So then you stay with your banks and your equipment providers, your industrials, who will be suppliers of either finance or actual goods into this sector.
Absolutely. So that's about it. I think there were a lot of questions, but I think it's the paucity of time. So Ajay, I think as always, brilliant insights, whether it comes to macros, as I said in my opening remarks about you, whether it's macros, whether it's geopolitics, and we could not speak a lot about politics as well. You briefly mentioned that as well. Whether it's the US elections. I don't know how many of you have seen this, but Ajay was one of the key proponents in terms of breaking down how US elections are conducted, what is the process related to that, Federal Reserve meetings, analysis of that when it comes to monetary policies all the time. And therefore, I think the insights that you got on the table, Ajay sir, for all of us are indeed very, very enriching, very knowledgeable as well. The time spent with you is well spent. We could have spent the next 4-5 hours with you and not get bored even for a single minute. And I'm pretty sure we'll have one more session with you. In fact, many more sessions with you, but one more in the next few weeks itself or the next few months itself. Pleasure having you again with us. Thank you so much. Obliged, and thank you all the users. I hope you had a lot of takeaways what Ajay had mentioned, whether it's macros, sectors to look out for, the themes to look out for as well. So thank you again, Ajay.
Just
Till we meet the next time.
One point, if I can make, Mayuresh.
Sure.
Yeah. I would say that all who attended today, you're on the right path. Because to hear a boring has-been talking on a Saturday morning when you could have done played golf or played cricket or watched something good on TV's latest movie, you have come and spent that time. And that is the differentiation. When I was working in GE, we were very lucky. GE used to really outspend on training, and I was in the top 200 officers globally, and we got a lot of training. And we had this executive coach, who came from Harvard, and we would have these retreats where CEOs from around the world would come. And I asked him on work-life balance, like the fool I was. I said, "Sir, is there?" He said, "There's no work-life balance. You want to succeed, you have to work. So there is no weekend." I said, "So what's the secret sauce?" He says, "You just love your job so much that it will not look like work, and give high quality time to your family, but rest. If you want to be CEO and you want to progress, there's no work-life balance." So I want to congratulate Mayuresh, all your team, and all the people who landed up today. This quest for knowledge, it keeps compounding, it keeps accumulating, and it generates magic. After a while, you will start seeing patterns. In Citibank, we were taught to see diagonal patterns, not only horizontal or vertical. And I had bosses who would just catch me when I would be hiding data also, because we were looking vertical and horizontal, and they would be doing diagonal patterns. So that's the thing that happens with learning. Very grateful to all who came to listen to us today, and grateful to you, Nilesh. You are a very old friend, so you are always very complimentary to me. But this was a very enjoyable session today.
No, it's wonderful having you, Ajay. So again, I think for the sake of repeating myself, I've been knowing Ajay for a long time. He's a great guy when it comes to knowledge and a great human being as well. So till we meet next time, Ajay, pleasure again. Thank you so much for taking time out on a Saturday, and the knowledge that you share, and with the simplicity that you share, I think it makes it very enjoyable for people to stick on and come back again and again. So thank you again, and thank you all the users for joining in. Till we meet again. Thanks, Ajay sir, and thank you everybody.
Thank you.